The question of whether the U.S. stock market will crash in 2025 has become increasingly significant as we've witnessed substantial market volatility in recent months. After reaching all-time highs earlier this year, major indices have experienced a dramatic pullback in April 2025, with the S&P 500 and Nasdaq both seeing significant declines. This analysis will examine the key factors influencing market dynamics, assess current conditions, and provide a forward-looking perspective on the likelihood of a full-fledged market crash in 2025. Current market situation. As of April 2025, the U.S. stock market is experiencing considerable turmoil. Looking at recent data, we can observe dramatic shifts in major indices. The S&P 500, represented by the SPY ETF, has declined sharply from its March high of approximately 595 to around 496 by April 8, 2025, a drop of nearly 17%. This brings the index dangerously close to bear market territory, defined as a 20% decline from recent highs. The technology-heavy Nasdaq, represented by QQQ, has fared even worse, falling from around 510 in early March to approximately 416 by April 8, a decline of nearly 18%. The Nasdaq has officially entered bear market territory, having fallen more than 20% from its December 2024 record high. The market has shown extreme volatility in early April, with significant daily swings. This volatility reflects heightened investor uncertainty about the market's future direction. Several factors are contributing to the current market turbulence and could determine whether we experience a full market crash in 2025. 1. Tariffs and trade war concerns, 35%. The most significant immediate trigger for market volatility has been President Trump's implementation of sweeping tariffs that began taking effect in early April 2025. These include a universal tariff on all imports, reciprocal tariffs on nearly 90 countries with the highest trade imbalances with the U.S., specific tariffs on automobiles, steel, and aluminum. The market reaction has been swift and severe. As reported by CNN, the tariff-induced market mayhem isn't over just yet. U.S. stock futures plunged Sunday evening after two sessions of sell-offs that wiped away over $5.4 trillion in market value. CNN. J.P. Morgan analysts estimate these tariffs will effectively raise taxes on Americans by approximately $660 billion annually, the largest tax increase in recent history. Furthermore, they project these tariffs could add 2% to the consumer price index, exacerbating inflation concerns that had previously shown signs of moderating. China has already retaliated with a 34% tariff on all U.S. goods, raising fears of an escalating and potentially damaging trade war. The retaliatory measures from other nations could further strain global trade relationships and economic growth prospects. 2. Inflation concerns, 20%. Inflation, which had been showing signs of moderating in late 2024, is now at risk of accelerating again due to tariff-induced price increases. The potential 2% addition to CPI would reverse much of the progress made by the Federal Reserve in its fight against inflation. Higher consumer prices could erode purchasing power, dampen consumer sentiment, and ultimately lead to reduced spending. Given that consumer spending accounts for approximately 70% of U.S. GDP, a significant pullback could substantially impact economic growth. 3. Interest rate policy, 15%. The Federal Reserve faces a challenging environment. At its March 2025 meeting, the Fed kept interest rates steady at 4.5% and signaled it would cut rates twice in 2025. However, the inflation implications of the new tariffs may force the Fed to reconsider its rate cut plans. If the Fed feels compelled to maintain higher rates to combat tariff-induced inflation, it could further pressure economic growth and stock valuations. Conversely, if the Fed cuts rates despite inflationary pressures to support economic growth, it risks allowing inflation to become entrenched, potentially necessitating more aggressive rate hikes later. 4. Corporate earnings downgrades, 10%. Analysts have begun revising corporate earnings expectations downward. According to LSEG-IB's data, S&P 500 earnings are still expected to rise 10.4% in 2025, But this represents a significant reduction from earlier forecasts of 14% growth. The impact of tariffs on corporate earnings will likely vary by sector. Companies with global supply chains and significant international exposure could face margin pressures from higher input costs and reduced international sales. Domestically focused companies might fare better initially but could eventually suffer if consumer spending declines. 5. Market valuation concerns, 10%. U.S. stocks entered 2025 with elevated valuations. According to Advisor Perspectives, based on March's S&P 500 monthly data, the market is overvalued somewhere in the range of 96% to 160%, depending on the indicator. Advisor Perspectives. These high valuations left little room for error, making the market particularly vulnerable to negative catalysts. The recent sell-off has brought valuations down somewhat, but they remain elevated by historical standards. 6. Geopolitical tensions, 5%. Beyond trade issues, various geopolitical concerns continue to weigh on markets, including ongoing conflicts in Eastern Europe and the Middle East, as well as tensions in the South China Sea. Any escalation in these areas could further destabilize markets. 7. Recession fears, 5%. The probability of a recession in 2025 has increased significantly. Goldman Sachs raised its recession odds to 45% in early April, up from around 20% in late 2024. JP Morgan raised its recession probability to 60%. The Atlanta Federal Reserve's GDP Now model briefly dipped into negative territory for Q1 2025, suggesting economic contraction may already be underway. While this model is volatile and subject to revision, it adds to the concerning economic signals. Wall Street analyst forecasts. Despite recent market turbulence, many Wall Street analysts remain relatively optimistic about the market's prospects for the remainder of 2025. According to a compilation of forecasts from 17 major institutions, the median year-end target for the S&P 500 is 6,500, implying 15% upside from current levels around 5,633. Yahoo Finance. However, several firms have recently revised their targets downward. Goldman Sachs, for example, cut its S&P 500 year-end target twice in the last month, from 6,500 to 6,200 and then to 5,700, citing slower economic growth expectations. Historical context. Market crashes and corrections are natural parts of market cycles. Since 1950, the S&P 500 has experienced 37 corrections of 10% or more, 11 bear markets, declines of 20% or more. The average bear market has seen a decline of approximately 30%. It's worth noting that not all corrections develop into full-fledged bear markets, and not all bear markets precede recessions. However, significant market declines do often coincide with economic contractions. Potential mitigating factors. Several factors could help prevent a full market crash or facilitate a rapid recovery. 1. Strong labor market. Despite recent concerns, unemployment remains near historic lows at around 4%. A resilient job market could support consumer spending. 2. Corporate balance sheets. Many companies strengthened their balance sheets following the pandemic, potentially providing cushion against economic headwinds. 3. Policy adjustments. If market declines become severe, there's potential for policy modifications. The Trump administration could modify tariff policies if economic impacts prove too damaging. 4. Federal Reserve support. The Fed could accelerate rate cuts if economic conditions deteriorate significantly. 5. Long-term growth potential. Technological innovation and productivity gains, particularly in AI and renewable energy, continue to create growth opportunities. Personal assessment. After analyzing the available data and considering various factors, my personal assessment is that while the U.S. stock market faces significant challenges in 2025, a catastrophic crash, decline of 40% plus from peak, remains unlikely, though not impossible. The most likely scenario appears to be continued volatility with potential for the current correction to develop into a moderate bear market, 20 to 30% decline from peak. Several key factors support this view. 1. Tariff implementation is likely to be moderated. While President Trump has initiated sweeping tariffs, there are already indications of potential negotiations with trading partners. The economic impact of the full tariff regime would be substantial enough that adjustments seem probable. 2. The underlying economy remains relatively strong. Despite recession concerns, key economic indicators like employment remain robust. This provides some cushion against a complete economic collapse. 3. Valuations were elevated but not at extreme bubble levels. While the market was overvalued entering 2025, valuations were not at the extreme levels seen before historical crashes like 2000 or 1929. 4. Policy tools remain available. Both fiscal and monetary policy options exist to counter severe economic deterioration if necessary. However, investors should prepare for continued volatility and the possibility of further declines, particularly if trade tensions escalate further with additional retaliatory measures. Inflation accelerates significantly due to tariff impacts. Corporate earnings disappoint more than current expectations. The labor market shows significant deterioration. Investment implications. For investors navigating this uncertain environment, several strategies merit consideration. 1. Maintain diversification. Ensure your portfolio is diversified across asset classes, sectors, and geographies to mitigate risk. 2. Increase quality focus. Emphasize companies with strong balance sheets, sustainable competitive advantages, and pricing power. 3. Consider defensive sectors. Consumer staples, healthcare, and utilities typically outperform during market downturns. 4. Evaluate cash allocation. Having some cash reserves provides both protection and opportunity to invest at lower valuations. 5. Avoid panic selling. Market timing is notoriously difficult, and panic selling often leads to missing subsequent recoveries. 6. Look for selective opportunities. Market declines often create attractive entry points for long-term investors in quality companies. 7. Consider hedging strategies. Option strategies or inverse ETFs might be appropriate for sophisticated investors seeking downside protection. Conclusion. The U.S. stock market faces significant headwinds in 2025, with tariffs and trade war concerns representing the most immediate challenge. The recent market correction has already erased most of the post-election gains, and further volatility seems likely. While a catastrophic crash cannot be ruled out, particularly if trade tensions escalate dramatically or policy responses prove inadequate, a more moderate bear market followed by eventual recovery appears to be the most probable scenario based on current information. Ultimately, long-term investors should remember that market downturns, while uncomfortable, are normal parts of market cycles. Those with well-diversified portfolios and appropriate time horizons should avoid making drastic changes based on short-term volatility. The key factors to monitor in the coming months include trade negotiations and potential tariff adjustments, inflation data and Federal Reserve policy responses, corporate earnings reports and guidance, labor market indicators, particularly the unemployment rate, consumer spending and sentiment metrics. These indicators will provide important signals about whether the current market weakness represents a temporary correction or the beginning of a more prolonged bear market. Stock market bear metaphor. In this environment of heightened uncertainty, prudent risk management, realistic expectations, and a focus on long-term financial goals remain the most sensible approach for most investors. Thanks for watching. Don't forget to subscribe to watch the latest videos, and share, comment your opinion. Thanks again.